Most traders stare at price, but Richard Wyckoff taught us long ago that the real story hides in the volume. And there's one secret pattern that whispers: accumulation. Before the crowd ever notices. Picture this: a stock has been falling for weeks, but suddenly the down moves start showing shrinking volume, while every small rally prints steady, controlled buying. To the untrained eye, it looks like just another range. But to the operator who studies the tape, this is the quiet footprint of the Composite Man absorbing supply. Then one day, a wide spread down bar appears, but instead of collapsing, price closes in the upper half on the heaviest volume in weeks. Weak hands panic, professionals buy every share they dump. This single volume signature, climactic selling followed by muted supply, is the silent announcement that accumulation is underway long before the breakout, long before the public wakes up. In the study of market operations, few phenomena are as revealing and as consistently overlooked by the public as the behavior of diminishing supply. Wyckoff taught us that every movement in the market is a direct reflection of the battle between supply and demand, and that the character of volume during declines tells us far more than the movement of price alone. When supply begins to dry up, it is seldom by accident. It is usually the deliberate footprint of professional operators who have already absorbed the floating stock and are now quietly preparing the next phase of the advance. The average trader, distracted by candles and indicators, fails to see this silent retreat of selling pressure. But the student of the tape sees it clearly, for diminishing supply is the first whisper of accumulation. Diminishing supply appears during the latter stages of a decline or within a trading range after a preliminary support event. The declines become narrower. Down waves shorten. Bars that once closed on their lows now begin to close mid-bar or even near their highs. Not because buying is strong yet, but because selling is no longer aggressive. In Wyckoff language, the Composite Man has already taken in a significant portion of supply earlier, often during climactic selling or sharp shakeouts. Once these weak holders are forced out, the market enters a period where selling pressure naturally reduces. The smart money does not need to buy hard. Yet, they only need to withhold selling, and that alone changes the entire tone of the chart. A key hallmark of diminishing supply is the appearance of low-volume down bars. These are perhaps the single most important clue a developing accumulation can offer. When price attempts to decline, but can only do so on minimal effort, it signifies a lack of participation by sellers. Professionals never dump stock at the bottom. They sell into strength, not weakness. So when a down bar prints on extremely light volume, it tells the observant trader that the Composite Man is no longer unloading. Instead, he is waiting, testing, probing the market to see whether any residual supply remains. If no selling appears on the tests, price stabilizes, the range tightens, and the market quietly transitions from a state of distribution by weak hands into a state of control by strong hands. The importance of diminishing supply cannot be overstated. It is the bridge between phase after pain and phase before opportunity. Traders who wait for breakouts miss the lowest risk position. Those who understand diminishing supply can position themselves before the crowd even knows what is happening. This is the essence of the Wyckoff approach. Reading the intentions of the professional operators through their footprints, not through their announcements. When diminishing supply appears repeatedly, and especially when combined with signs of absorption, structural support, or bullish tests, it becomes one of the most reliable precursors to a major markup. In essence, diminishing supply is the quiet but unmistakable signal that the Composite Man has stopped selling, and that soon, he will start buying. To understand the true mechanics of accumulation, you must first understand the silent but relentless force behind it, the Composite Man. Wyckoff taught that every market, whether it be stocks, crypto, or Forex, behaves as if one master operator, an entity far more patient, disciplined, and strategic than the public, controls its movements. This composite man does not chase price. He does not react emotionally. He operates with a single objective: to accumulate a large position without causing the market to rise prematurely. And the method he uses to achieve this is the process known as absorption. Absorption is the cornerstone of accumulation. It is the phase where the composite man systematically removes supply from the market, quietly, gradually, and decisively. To the untrained trader, the price seems to be doing nothing during this period. It drifts sideways, oscillates back and forth, or reacts to minor news without making any real progress. But beneath this apparent inactivity, a powerful transformation is taking place. Every time weak holders sell in fear, confusion, or impatience, the composite man stands ready to purchase those shares. He welcomes their selling, because each transaction brings him closer to controlling the majority of the floating stock. This gradual absorption leaves unmistakable footprints for those trained to see them. Down bars that previously fell freely now begin to shorten as the composite man absorbs every share offered. The volume on these declines often remains elevated, not because the crowd is buying aggressively, but because the operator is soaking up supply with precision. Price closes off the lows and the spread narrows, not due to bullish enthusiasm, but because selling pressure is being consumed faster than it can be produced. Eventually, even when bad news hits, the market refuses to drop meaningfully. This is the composite man's signature. He has absorbed so much supply that the market can no longer decline under normal selling. Another hallmark of absorption is the resistance to downside movement. Traders may see a sharp effort to push price lower, but the result is minimal progress. Wyckoff called this the effort vis result principle. When significant volume appears on a down move yet price barely reacts, it tells you the operator is sitting on the other side of the trade, absorbing the selling with ease. This is one of the most bullish conditions a chart can display. Absorption also explains why the public often misinterprets accumulation as choppy, boring, or trendless behavior. They do not realize that the composite man is not in a rush. He needs time to build his position without alerting the market. If price rises too quickly, he cannot accumulate enough. If it drops too far, panic may cause excessive volatility. So he maintains equilibrium, supporting the market just enough to prevent breakdowns while absorbing supply at favorable levels. Once the composite man has absorbed sufficient shares, the transformation is complete. Supply evaporates, selling dries up, the market becomes spring-loaded, and when the operator finally allows price to rise, the move is swift, powerful, and shocking to the public who slept through the absorption phase. In essence, composite man absorption is the invisible preparation for visible trends, the quiet engineering that makes every future markup possible. Climactic selling is one of the most dramatic and revealing events in the entire market cycle, and Richard Wyckoff considered it a pivotal moment where the intentions of the composite man become visible to those trained in tape reading. It is the point where panic reaches its peak, where the public throws away shares in despair, and where professionals silently and systematically seize control of the market. While most traders fear this violent action, Wyckoff students recognize it as the opening chapter of a potential accumulation phase. Far from being random chaos, climactic selling is a highly organized event where the market transitions from weak hands to strong hands in a swift, emotionally charged transfer. Climactic selling typically occurs after a prolonged decline, weeks or months of downtrending action in which the public has grown increasingly hopeless. Bad news dominates headlines, price breaks support after support, and each minor rally is met with renewed selling. By the time the selling climax appears, the market has already worn out the average participant emotionally. They are exhausted, uncertain, and vulnerable. Then comes the final blow, a massive, violent decline characterized by extremely wide spreads and record-breaking volume. To the public, this is the moment of ultimate fear. To the composite man, it is the opportunity he has been waiting for. The essence of climactic selling lies in the distinction between effort, volume, and result price spread. During the climax, the effort is enormous. Panic-driven traders dump shares without hesitation, margin calls force liquidations, and retail traders capitulate with market orders. Yet despite all this selling effort, the result eventually begins to change. Price stops falling with the same ease it did earlier in the downtrend. Late in the climax, even as volume remains extremely high, the market starts closing off its lows, signaling that buying is quietly overwhelming the flood of selling. This is the composite man absorbing everything the crowd is dumping. Visually, the selling climax concludes with a huge down bar followed by a powerful rebound, a swift upward reaction that Wyckoff referred to as the automatic rally. This rally does not occur because the public suddenly becomes bullish. It happens because there is simply no more supply left. The composite man has absorbed nearly all of it. This rebound is one of the strongest clues that the decline has exhausted itself and that the market is transitioning into phase A or B of accumulation. But climactic selling is not just a technical event, it is deeply psychological. It represents the point where the collective emotional state of the market reaches maximum pessimism. The public believes the decline will continue indefinitely, unaware that the composite man is taking advantage of their fear. Wyckoff understood that markets tend to reverse at the moment of greatest emotional intensity, not when conditions are calm. Climactic selling is that moment, a dramatic purge of weak hands. After the climax, the market typically enters a range where supply is tested again. But the most important work has already been done. The composite man has gained control. And with control comes the ability to shape the next trend. In short, climactic selling is the beginning of the end of a downtrend, and the beginning of accumulation. It is fear turned into opportunity, emotion turned into strategy, chaos turned into structure. In Wyckoff's teachings, few analytical tools are as powerful or as misunderstood as the volume-spread relationship, the dynamic interplay between the effort behind a move and the distance that move travels. Wyckoff believed that price alone is insufficient to understand market intention. Volume alone is incomplete. But when the two are observed together, with the trained eye of a tape reader, the market becomes a transparent organism whose internal motives are exposed. The volume-spread relationship is the language of the composite man, the dialogue between supply and demand written bar by bar, revealing whether professionals are active, absent, absorbing, or unloading. The foundation of this principle is deceptively simple. Volume represents effort, and spread represents result. When effort and result align, the market behaves normally. Strong volume produces strong spreads. But when effort and result diverge, the smart trader knows something significant is happening beneath the surface. Every inconsistency in this relationship is a footprint of the composite man. Consider a wide down bar with enormous volume. To the novice trader, this looks purely bearish. But Wyckoff students look deeper. Was the close near the low or off the low? Was the spread wider or narrower than expected? If the spread is narrow despite heavy volume, this suggests absorption. In other words, someone is buying the panic-driven selling quietly, methodically, professionally. The effort is higher volume, but the result is muted tight spread. That is not weakness. That is strength disguised as weakness. Conversely, a wide-up bar on huge volume that closes poorly may signal hidden supply. Again, the effort is high, but the result is disappointing. Price cannot advance despite the energy thrown behind it. This hidden selling into strength is the composite man distributing his inventory to late buyers. The public sees a bullish candle. The tape reader sees a warning. During accumulation, The volume-spread relationship often reveals diminishing supply before the breakout ever forms. Down bars begin to show light volume, indicating a lack of selling interest. Up bars may show moderate, controlled volume. Professionals supporting price just enough to hold the structure without causing a premature markup. The spreads become tighter, the volatility softens, and the market takes on the character of quiet preparation. This subtle shift is invisible to most, but obvious to those who understand effort vs result. During distribution, the opposite occurs. Up bars show increased volume but little progress. Professionals using strength to unload. Down bars may suddenly widen on lower volume, indicating that once support is removed, the market falls easily due to a lack of demand. Here, the volume-spread relationship exposes fragility before the breakdown. Testing is another crucial application. A test with low volume and narrow spread, especially after a shakeout or selling climax, indicates that supply has truly dried up. This is one of Wyckoff's highest quality signals, but a test with increasing volume or a wider spread warns that supply remains and the operator is not yet satisfied. Ultimately, the volume-spread relationship turns the chart into a conversation. Every bar speaks. Every inconsistency reveals intention, and every imbalance exposes the silent operations of the Composite Man. Those who master this relationship cease guessing and begin interpreting. One of Wyckoff's greatest gifts to traders. In Wyckoff's methodology, the most profitable trades are not taken after the breakout, as the public tends to do, but before it, when the Composite Man has already signaled his readiness and the chart quietly reveals confirmation of strength. These subtle signatures, known as pre-breakout confirmations, are the final clues that an accumulation phase is nearing its moment of truth. They are the footprints of an operator who has completed his absorption, eliminated most supply, and is now preparing to let the market rise. The public sees sideways consolidation. The Wyckoff trader sees tension, intentionality, and imminent release. Pre-breakout confirmation begins with the drying up of supply tests. After a selling climax and the subsequent phases of the range, the operator repeatedly tests the market to ensure no significant supply remains. These tests might appear as dips into support, minor shakeouts, springs, or intraday flushes. What matters is not the shape of the bar, but the character of the volume and spread. A true pre-breakout test has narrow spreads, low volume, and strong closes, evidence that sellers are gone and only weak remnants remain. This internal quieting of supply is one of the most important signals Wyckoff traders look for. The next confirmation is the presence of higher lows within the structure. This subtle rise in demand is rarely dramatic. In fact, it is intentionally understated to avoid attracting public attention. Higher lows indicate that buyers are stepping in earlier each time price retraces, creating an upward tilt within the range. It is a sign that control has shifted decisively into strong hands. The Composite Man is now supporting price, preventing it from falling back into the deeper parts of the range. This behavior reveals that supply is not only depleted, it is being actively defended. Another essential sign is the emergence of bullish volume signatures near resistance. Before a breakout, the operator often nudges price toward the upper boundary of the trading range, generating slightly increased volume but controlled spreads. This upward probe is not the breakout itself. It is a deliberate test to gauge how much supply remains just beneath resistance. If supply is light, the probe closes well. If supply is present, price hesitates or rejects sharply. A series of successful probes, each showing better closes, tighter spreads, and smoother pullbacks, is one of the strongest pre-breakout signals available to a Wyckoff trader. The concept of effort with no result also plays a major role. When attempts to push price downward fail to produce meaningful declines, it signals that the operator is supporting the market. Sellers push, but nothing happens. This lack of downside follow-through is a hallmark of imminent strength. Wyckoff students recognize that the market is no longer responding to supply. Instead, it is coiling, compressing, and preparing for release. By the time all these signs align, low volume tests, higher lows, bullish probes, failed attempts to break support, the market is effectively telling you that the breakout is no longer a matter of possibility, but of timing. The Composite Man has locked the structure, and demand is about to express itself in a visible way. When the breakout finally comes, it will often be sharp, decisive, and immediate, leaving unprepared traders chasing while Wyckoff traders are already positioned. Pre-breakout confirmation is the difference between reacting to the market and reading it in advance. It transforms the trader from follower to strategist, from observer to operator. It is the final whisper of the Composite Man before the markup begins. In the end, the true power of Wyckoff's method lies in its ability to reveal what the public cannot see. Diminishing supply, Composite Man absorption, climactic selling, the volume spread relationship, and pre-breakout confirmation are not isolated concepts. They are chapters of the same story, the transition from weakness to strength. When you learn to read these footprints, the market stops looking random and starts speaking with clarity. You no longer chase breakouts or fear declines. Instead, you understand the silent work of the Composite Man and position yourself before the move everyone else chases. This is the essence of Wyckoff, seeing the truth beneath the surface and trading with the forces that truly move the market.